that's my trading account as of the close of Friday's trading session. And I made a little over $18,000 that day alone, which is quite a lot of money to make in a single day. And I don't usually make that much money. I wish I did, but I don't. The reason I'm bringing that up is because it is a testament to some pretty significant foundational shifts going on in the financial markets as a result of the economy. And my expertise, look, the idea of FOFTI is to take what you are good at and what you've leveraged and developed over your career and apply it, right? And so for me, that's my understanding in economics, which I have an undergraduate degree in, and also all the experiences I've had across investment banks, hedge funds, and so on and so forth in my career. Now, as a side income stream for myself after quitting my job, I do have investments into the stock market. Now, I'm not a day trader and I don't go in and out of trades multiple times a day. I don't have time for that because I'm focused on FOFTI. I do make trades and investments maybe about 4 to 5, 6 times on an entire month. So that's how, I guess, infrequent I trade, and I treat it as passive income. Now, last Friday, there was quite a drop in the stock markets, which I was positioned for. So my positions in the stock market do well when it tanks because I have short positions through ETFs, basically, and they're very easy to get into and get out of. And the amount of profits I made that day is a signal that a shift has occurred in the markets and as a result in the economy. And while this is not a financial vlog and get-rich-quick scheme, like all the other ones out there, I do bring this up because everybody should be familiar with a couple of core concepts and foundations of what is going on so that you can prepare accordingly yourself. And I made a video earlier over here that you can see about what I call the coming Greater Depression, which I still believe is coming our way, and that if you can prepare ahead of time, you'll be not only be able to take advantage of the situation and benefit from it, but also avoid a lot of pain and suffering if you're caught off guard. Now, there's just really two core things I'm going to talk about without complicating things. One is just something called the yield curve and the inversion of it. And the second thing has to just do with something you're all familiar with, which is unemployment and the measurement of unemployment. Then I'll talk a little bit about what's going on with the stock market, at a micro scale, and then translate that into what's going on with the economy, which is driving it, and how that impacts you, me, and everybody else in our daily lives. So the first thing I want to talk about is this thing called the yield curve, which is currently inverted. Now, just to boil it down into super simple concepts, we have something called the U.S. Treasury, which is, look, a very safe way to put your money. You basically give it to the government. You give your money to the government holds the money, and in rewards for you giving your money back to the government, it pays you some interest over time. So you can buy something like a 10-year U.S. government bond. So you give your money to the government takes their money and holds it for 10 years and thanks you when the 10 years are up by giving you back your money with a little bit of interest for loaning the money to the government for 10 years. And so they have something called a 10-year U.S. government bond. They also have one in different time frames. They have a 2-year U.S. government bond or treasury bill. And so you can buy and sell these things, right? And basically, normally what happens is the longer the time you give the government your cash, the more they'll pay you back in terms of interest when that time is up. And that's just obvious, right? Because the longer you extend time, let's say 30 years, right? If you give the government your money for 30 years, well, you'd expect more back at the end of 30 years because there's a lot of uncertainty. You don't know what's going to happen in 30 years, right? All sorts of things can happen, including wars and unpredictable things. And they took your money for that long, and you could have done a lot of things with your money for that amount of time. And so there's an opportunity cost for giving up your money for that length of time. So usually the longer they hold your money, the more interest they'll pay you. And so that's the normal setup, right? If you have a 2-year treasury or government bond, they give you less in exchange for them to take your money from you for that time. Now what happens is when there is an inversion of that, meaning all of a sudden the government's going to give you more money, or the market price for buying that 2-year government bond is a lot more interest than the 30-year, which is the flip. And the reason that would ever happen is because the short term has become so volatile and uncertain and insecure and risky that the market is willing to pay you even more in return for, even though it's a shorter period of time, to take your money, because things are so risky now. We don't know what's going to happen in the next 2 years even, right? Things could blow up. So that's why they'll give you more time, more interest and payment rather, when they give you your money out. And that is not normal. That is an inversion of the yield curve. Now, if we look over here in this yield curve inversion chart, this shows you basically it's inverted every time it goes under zero, okay? And so if you look at this, every time it's gone under zero, right, we've had these gray bars, and these gray bars are what you call recessions, which we haven't had in quite a long time. Now, if you look at this, it's not when we cross zero downwards, which is the moment when it becomes inverted, but rather when we cross back upwards, right, when the gray bar starts, right? So what that tells you is it's actually not when the yield curve inversion occurs where the trouble lies. It's actually when it uninverts, when the recession is near, right? And so here we have this, the last one we had was COVID, and it touched it and went back up, and the moment it went back up, we had that really fast recession, even if the stock markets crashed and lost value over 30%. And this was in 2022, I made this chart and actually showed it to my clients, warning them of this. So we entered the inversion in about 2022, right? We went in. And so the warning was, look, we're about to end. That doesn't mean the recession is going to happen tomorrow, because there's a time lag. And in fact, there's an 18-month average lag from the inversion, from when it crosses zero to the actual recession. So 18 months is about 2 years ago. And if we look at what's going on right now, if you look at this, we're literally about to uninvert. And the inversion is between the 2-year and 10-year yield. And so without all this heebie-jeebie complicated economics, all you got to know is there's this thing called the inversion. Every single time that has happened, a recession has followed. Every single time. It is one of the most accurate macroeconomic indicator that foretells a recession. One can make a case maybe once it didn't happen, but even that's flaky, because the economy actually had a big downturn, right? Whether or not it was a recession, that's up to some debate. But basically, it's happened every single time. And what I'm telling you is, and what I've been telling people since 2 years ago when I started preparing, was the moment the inversion happened, I said, look, there's an 18-month average from when that happens to when the recession hits. That's kind of like the window I have to prepare for what's about to happen. And now we're about to basically invert backwards, right? And uninvert, go above zero, which means that the recession is kind of close. Now, there's a lot of talk about people in the past 2 years like saying, oh, there's going to be no recession, there's going to be soft landing or even no landing, meaning there's no recession, no downturn at all. They say this time is different. These are the same people who've been saying when inflation first hit, oh, the inflation is not for real, the inflation is transitory. And of course they were wrong, and after some time they realized that inflation was not transitory, and then they had to jack up the interest rates super high, which caused all sorts of problems, including the Silicon Valley Bank implosion that happened just a year ago, if you think about what's been going on. And again, they're wrong, right? The recession is going to happen. No, we did not change history and physics of economics. It's happening. Now, what happened most recently, last Friday, was the stock market has been going up and up and up. And I've been going in and out, making these trades, like I said, every couple of times a month, like 4 or 5 times a month I make a trade. And each trade, I make a decent amount of money, enough to supplement what I'm doing. And I've been writing it up, and bad news was always perceived as good news, meaning like, oh, the Fed's going to cut interest rates, so that's good for the market. Well, the market continues to go up. Well, finally, there was a flip in the psychology last Friday where bad news finally became bad news. And the bad news was that unemployment is going up. And as a result of that, yes, the Fed's going to have to cut rates, but that's not a good thing, right? It's cutting rates because there's something bad coming, right? And that is a recession. Now, we talked about one thing, the yield curve and its inversion. That's just one. There's the second thing that I want to talk about, which is unemployment. And now if we look at this chart over here, unemployment is tricky, right? Especially because it's politically motivated. They start to manipulate the numbers. And if you look at since, but almost a year and a half ago, every time they come up with the jobs report, it's been revised later, many months later, into basically they've revised it down, right? So when they come out with a jobs report, the headline says, oh, we're creating a lot of jobs. And a few months later, when no one's looking, to say, oh, actually, we didn't create as many jobs. Well, that's been going on for basically ever since the beginning of 2023. If you look at this, mostly negative downward revisions, right? Constantly. And that's not a surprise because look, there's an election coming up and people do things, right? Like we say the Chinese manipulate numbers. No, everybody does. And, it'd be a fool to think that they don't, right? So when there's an election year, that year, for sure, there's going to be some, funny business such as this. So it's very hard to rely on just the raw, you'd have to look at the revised numbers to see what's really going on. Now, one way to look at things where you can like smooth out all of this manipulation, if you will, is by using something called the SOM rule, which is, you take the moving average of 3 months and you see if it crosses that or not, right? So because you're averaging out things, there's this backwards changing the numbers after the fact kind of gets mitigated. And this is the second other economic indicator that has been super accurate. Like basically every time we have crossed this line, this red line here on the SOM rule, was made by this lady who was part of the Treasury, by the way, we've entered a recession, right? We've entered a recession every time we've crossed over this red line. This recession was really quick because it's a COVID recession. And we're about to cross this line again. So, these two things. Now, let me show you one more thing. If you take that SOM rule and you expand the 3-month moving to 24 months moving, which basically means, you're even smoothing it out even more, right? Because we had to smooth out to more than 3 months because they've been manipulating the numbers for a year and a half now, right? So if you smooth it out to over 2 years now, which is enough smoothing out, you'll see that every time, right? We've had and these are significant situations. The 70s, the double dip, the SNL crisis, the tech bust, .com bust, the great financial crisis in 07, 08. That was painful with the pandemic. And now the question here is, what are we going to get? Let me tell you what we're going to get. We are going to get a recession. And I think it's going to be a pretty severe recession. Do you know that the amount of inversion in the yield curve is at the record? In fact, it's the most inverted it's ever been for the second longest time. And the only time it was inverted more was, guess what? In the 1928 to 29 Great Depression. We're more inverted than back then. And some people are saying, well, no, it's not going to be so bad because the government's printed a lot of money and stuffed people with paychecks into their pockets. And that's true, they have. And that's why this lag has been extended, which makes people think it's not going to happen. It's going to happen. But while that is true, the problem is they've unleashed the inflation genie because they printed too much money, just stuffed people with all the money. And so spending went up and, we had price-induced inflation from demand, pull side, right? And so what's going to happen now is when they cut rates, because they're going to have to, because we're going to have this recession, it's going to reignite the inflation genie, which is going to make the situation that much more worse and potentially, well, I don't think potentially, I think it's going to happen, tip us over into something a lot more severe than your run-of-the-mill recession, which is a depression. Now, if you think about the market action, okay, now I'm just going to talk a little bit about, now this is not trading and investment advice. I'm not telling you what to do with your money. I'm just showing you what I'm doing with my money. What you do with your money is your business. Go seek a registered legal investment advisor if you want to have somebody advise you on what to do with your money. But look, what I'm doing, which take it as entertainment, is I'm looking at something called the VIX. And if you saw earlier in my trading portfolio, I was trading, one of the instruments I was trading was the VIX, which is volatility. It's a formula actually that measures kind of like the fear index, if you want to call it, just want to make it simple. And it is in the RSI, which is a way to, it's called the relative strength index, but a way to measure like the overboughtness or the oversoldness of any investment instrument. It is way elevated, right? So on Friday, it went all the way up here. And, basically when it reaches these extended modes, there is a severe and pretty, big pull down, right? And the pullback in VIX means that the stock market will rebound, which is why I exited and cashed out of all of my positions on Friday and took the profit to see what's going to happen. Now that doesn't, nobody's a fortune teller and can tell you exactly what's going to happen, but what you do is you go based on probabilities. And the probability here is that it is likely, more likely than not, that this is going to go back down because it's just in a way overbought situation. And that means the stock market's going to go up, which means I should close my shorts and take profit and not, and wait for a better entry point again. Does that mean that the stock market's going to go up? It could, right? We could have a pretty meaningful bounce either next week or the week after soon, right? And I mean, I wouldn't discount the possibility of the S&P reaching new highs. I don't think the NASDAQ is going to reach new highs because I think the AI bubble has already popped already. So if you just saw what happened to Intel on Friday, I mean, it was devastating. It hasn't crashed like that in many, many decades. But S&P could continue to possibly go up, maybe even make new highs. But the point here is when we look at this like yield curve inversion, if I go back here, these are kind of long time frames. Look, this is a span of 70 years here, right? 70 years from 1954 to 2024. So even when it looks like a blip here, it's months and months, right? And so we could rebound and go back up from here, months and months, right? Maybe make a new high in the S&P, right? And if you know what divergence are, there's divergences all around the place. And so, no, I don't expect us to tank. Could we tank and just completely crash like 1928 style next week? It could happen, yeah, because make no mistake, the fundamentals are like that. But will it happen? I don't think so, and that's why I cashed out. And I'm going to wait to see what the market tells me and basically position myself to take advantage of that. The last thing I just want to mention here is there's this thing going on in Japan with the Japanese yen and how it was basically crashing. And the government had to step in and save it, which caused the stock market in Japan to completely collapse. Like the second worst ever collapse in history in Japan happened on Thursday, Japan time, which is, pretty significant. And you have to watch what's going on in Japan because that's basically where the US is heading, where they printed way too much money to save themselves. And then now they're kind of broke, so they're buying their own debt. And they've been doing that for a long time, what they call yield curve control, which the U.S. might head into, right? If they run it, that's probably the next step here, is that this crashes and then they go into yield curve control mode, which is the ultimate of money printing experiments, which Japan has been doing for decades. And now Japan has hit the end, right? It's hit the end where it can't do both, which is save its currency at the same time foster growth in its economy. And that's where we're most likely heading, barring some geographical, geopolitical flare-up, which I made another video about over here that you can see. And just this weekend, with the assassination of the Hamas political leader and more Hezbollah military leaders in Lebanon, the entire world is waiting for Iran to strike back. We'll see what happens. But, as I mentioned in that video, the pace is accelerating of the unthinkables, and we will have the next unthinkable unfold within the next 2 weeks. And what that means, we'll have to wait and see. But the main message here is, look, things are accelerating. Preparation should be made. Don't wait. Time is slowly running out. I should rephrase that. Time is quickly running out. Things actually, even from what I thought was going to happen 2 years ago when I started this whole journey to prepare, is accelerating, not slowing down. And while there still is time, one should take a look at yourself first of all, from your safety, your family's safety. Just make sure you have outlets, right? And that you have ways to escape in case that there is such a situation. Then financially as well, have multiple, start broadening and diversifying your income streams. Don't just rely on your paid salary job, because I'm telling you right now, when this happens, it's going to happen quick. And many jobs, I mean, we've already seen quite a lot of job cuts. Many more jobs are going to be lost. Even unthinkable jobs, meaning like super stable jobs, will be at a loss. And you don't want to be on the chopping block unprepared when that happens. This is my whole point, why I took advantage of what I understood was going to happen and started preparing ahead of time 2-3 years ago, so that I'd be fully prepared when the time came. And that's what FOFTI is also about, is that preparation and to exercise critical thinking and not just follow like sheep to the masses what everybody else in mainstream media is telling you, but to think yourself with your own information. We have the internet now. You can find and read things out. This is not the 1920s anymore, where information was locked into a few groups of people. The question is, how do you discern from good from bad information? That's something that you'll just need to sift through, right, using critical thinking. And the point here is to take advantage, take control of the situation. Don't be passive. Don't let it control you when it happens. People ask me, hey, you're creating a startup when you think there's going to be a recession. Isn't that stupid? Actually, no, it's not stupid. The whole point here is that I've accumulated enough support and income to last me enough time for me to build the product, which is FOFTI, which is really to help people going through tough times, mentally and spiritually and physiologically, to prepare for this. Such that while I do this development and building phase, while I have side streams of income, that when the recession is over, that I would have finished out the product and product market fit, and that I could be able to help more people when times are better. Some of the best startups have built their products during recessions, when there is a downturn. That's when you accumulate, get and discount things that once used to cost a lot, now you get it for really free or get it cheaply. And that includes not just companies and IP, but also human capital. Build a network, gather people together in community. These are the things that I'm doing right now, and that I hope will be in preparation from when there is a turnaround afterwards. And so that's why for me, I do think it's a good time. And I mean, business and all that aside, the whole point of doing it is to help people, right? And there's going to be more and more people that are going to need support and help in a way to weather the storm spiritually and mentally and psychologically. And I'm building that up and I'm applying it to myself, right? And so that's why I'm very candid with what I'm feeling. When I have days that are not great, I share it with all of you so you can see how I actually feel, and how, through FOFTI I don't succumb to it, right? And so that, you understand that this thing actually works as I document how I'm using it to weather through. And so that's my hope, right? Anyway, it wasn't planned recording here, but things are moving pretty quickly, and I just wanted to share this with you, my subscribers, who have a chance to listen to what I'm saying. Peace.